All right, we are back. Hope you had a time to catch a breath and visit some of the startups and connect with folks at virtual tables, but we are right back on time. Now it's time to introduce our next talk. I'd like to invite Yash Talreja to introduce the next fireside chat. And Yash is longtime supporter of IIT Bay Area and financial advisor. So let Yash please take it away from here.
Vivi, thank you for the intro. It's my great pleasure to introduce our next topic, raising money in a post-pandemic world, problems and opportunities. Over the past 1.5 years, the world has experienced a massive disruption in social and economic norms. However, not only has the entrepreneurship persisted through the pandemic, it has actually thrived. So what are the challenges and the opportunities? Our guest, Kittu Kolluri, is uniquely qualified to offer his insight into these challenges and opportunities in the current environment. He's a graduate of IIT Madras and has an illustrious career spanning more than 3 decades as a serial entrepreneur, CEO, and venture capitalist. He started his career as a software engineer at Silicon Graphics, went on to co-found Healthion WebMD, which went public in 1999. His next startup, Neotribe, a pioneer in SSL-based access technology, was acquired by Juniper Networks. At Juniper, Kittu served as the executive vice president and the general manager for the enterprise security base business before becoming a general partner at NEA in 2006. Kittu is profiled by acclaimed author Michael Lewis in his book, The New Thing, and was named as one of the top 100 venture capitalists by New York Times in 2016. Our host, Kirtika, is also a bright IIT Madras alumnus. She's a senior software engineer at Google, where she had led various initiatives in wireless and operating systems, networking, and hardware. She will be leading the fireside chat conversation with Kittu. Take it away, Kirtika. It's all on you.
Thank you, Yash. Pleasure to be chatting today with Kittu as always. Kittu, let's start with the economic climate. We've been through a lot in the last 18 months, starting with a screeching, grinding halt due to COVID, followed by very swift and some might even say excessive fiscal intervention. And now we're at a point where we're talking inflation and frothy markets, and all in the span of 18 months. How does this compare to your previous experiences and what are you seeing?
In my 30 plus years in this ecosystem of entrepreneurs and venture, I've been through about 4 or 5 different downturns. And this one is definitely very different in a few ways. One is, as you mentioned, the fiscal and the monetary stimulus was swift and overwhelming. But it papered over some of the issues. It created demand in certain areas, and there was loss of demand in certain other areas. But the recovery was more of a K-shaped recovery rather than a U-shaped or a V-shaped as was being predicted. There are certain sectors in our economy that have actually benefited and certain other sectors that almost irreversibly damaged.
So what are some of the macro trends stemming from what we've seen over the last 18 months? I recall we were chatting a while back and you said that the demand has come back, but the supply is not, and we are facing a very unprecedented supply crunch. So talk us through that and some other things that you see.
If you think about how our economy has changed over the last 2 to 3 decades, Kirtika, information technology and globalization has globalized our economy and globalized various industries. And so they have come to rely on suppliers outside of the United States. However, the COVID pandemic has made it really difficult to transport goods from other countries, whether that be China or Taiwan, into the United States. And that's created a significant crunch, particularly if you are thinking about, in the hardware industry, if you have a product that has a dependency on hardware, whether that be chips or other kinds of boards and things like that, that's created a huge a gap in supply. And now companies are being forced to look for suppliers closer to home. However, those suppliers are facing a demand that they just can't meet. And so what they're doing is they're just prioritizing some of their larger customers. And so if you're a young startup, then this is a very challenging period of time. That's one kind of macro trend. There are a few others that I'd like to touch upon. Labor shortage. There was massive unemployment in the immediate aftermath of this pandemic. And as we discussed, the federal government came in and threw money at the problem. They printed money and threw money at the problem. And so there was a lot of stimulus, both for individuals, families, as well as for small businesses. What that did was that it gave people an opportunity to rethink their lives in a sense. And so there were certain jobs that people were doing prior to the pandemic, and they've not gone back to those jobs. So if you are in the restaurant industry, as an example, it is so hard to find people to work in the restaurant industry right now. And that's just scratching the surface. You have other industries like, mining industry, or the waste management industry, or even parts of the food and agriculture industry. For instance, we were talking about this earlier. There is food packaging. For instance, if you're packaging spinach or lettuce, you have to work in some very oppressive environments. You're working in refrigerated environments. And so for a lot of people, that was their livelihood. They suffered through it. But post-pandemic, they're like, no mas, we're not going back to that. That's another interesting macro trend. City populations have gotten redistributed. Pre-pandemic, we saw a huge surge in population in the cities, whether that be San Francisco or New York or LA. There were a lot of companies that were actually situating their headquarters in these large cities because the millennial population kind of congregated into the large cities. However, post-pandemic, there has been a massive exodus out of these cities. It's kind of gotten corrected a bit more recently, but nowhere near pre-pandemic levels. So that's another very interesting phenomenon that I've noticed. I call it the hollowing out of some of the major cities that we've had recently.
It's not just the individuals who are moving away. Companies are shifting their headquarters too. And I was chatting with you, and you said that some of your portfolio companies have considered that option as well. So I think in a state, a couple of things, right? One is as employees have been forced to work remotely, they have found ways to work remotely from either their hometowns, or they've moved away from the Bay Area and moved to remote locations, which are arguably more livable places. And when they've discovered this new work-life balance, they're disinclined to come back to the Bay Area if they can help it. And if it doesn't affect their careers in an adverse sort of way. So that's one interesting phenomenon that we're seeing. And there are some companies, as you know, that are actually saying, we're moving to a completely remote, 100% remote. I think Twitter is one of those companies that said that they were not going to go back into the offices.
lot of large companies, including Google, Adobe, have not yet laid out their back to the office policies. But in addition to that, a lot of companies are now looking at this as an opportunity to say, hey, should we be moving our headquarters to a different state altogether? Because if we are going to leverage a distributed workforce that's all working from home, then do we really need to be in California? And do we need to pay some of the high taxes that we're paying in California, the corporate taxes? And so it's not as much of an issue, truth be told, for young companies, because most of these companies are not going to be profitable for the foreseeable future. So it doesn't really make that much of a difference. But for companies that are profitable, it is a big deal. So there is definitely those conversations happening in boardrooms all over the Bay Area to figure out, okay, is it time for us to consider that? And it's something that I'd say the state of California had better take very seriously, because we depend a lot on income from tax income for the budgetary needs of the state.
So, Kittu, one thing that comes to mind here is, as lots of individuals are contemplating, being in concentrated tech centers versus remote, we often hear stories, and one relevant to you is during the Robinhood IPO, there was this lore going around that you were definitely one of the early believers there, but what helped you solidify your hypothesis in the company was a walk with the founders on Stanford campus. So a lot of people are thinking about how necessary is that element of physical interaction going to be moving forward. Any thoughts on that?
Yeah, great question, Kirtika. Again, in the immediate aftermath of the pandemic, a lot of us in venture found ways to do deals even without meeting entrepreneurs. I remember I had my first deal that I had done without ever meeting the entrepreneur and would wired the money was in a company called Vendia. Those founders came very highly recommended by people in my network, and so we felt comfortable doing so. However, it felt very odd and very awkward for me to do that. And I think now what we want to do is, the early part of the diligence process, we don't really need to meet the founding teams. However, I feel that you miss out something when you don't actually interact with the people in a live setting, because Zoom doesn't do a great job of understanding people's body language, understanding facial expressions, nonverbal communication, and just getting to know people's life stories. We're jumping from one Zoom call to another Zoom call with the click of a button. It's become much more transactional, and so that's something that I don't enjoy as much. And for me, I think we've discussed this within our partnership, that we want to reinstitute the habit of meeting the founding team before we actually make the formal investment. We think it's very important. That human touch is very important.
That's a great insight. Going back to economic climate and scenario, and I'm sure a lot of people are curious to hear about your thoughts on how the VC industry is doing. And I want to throw in a note about a very similar chat you and I had 10 months ago at an IIT Madras event. And at the time, you said things like the gap between Main Street and Wall Street is increasing, deficits are going to increase. And I will admit that it sounded a bit like platitudes, but looking back, it's mind-blowing that not only were you directionally correct, but the magnitude of it over the past 10 months has been astounding. And VC is not just resilient, it's on steroids. So would love to hear your thoughts on that.
Yeah, you're absolutely right that the gap between what we refer to as Main Street and Wall Street has definitely widened. It's become a chasm. It's become a huge chasm. And for those of us that are beneficiaries of what's happening with the stock market and things like that, it almost feels like, hey, were we even part of a pandemic? It's almost like it's been business as usual, and whatever parts of the business that have changed, it's actually been somewhat to the upside. But I think that what we're seeing, particularly sitting in the venture capital seat, what we're seeing is a huge amount of capital coming into venture. There was a short period of time when there was a dip in the amount of venture capital that went into startup companies right out in sort of Q1, Q2 of 2020. However, the second half of the year saw a huge rebound, and we basically eclipsed the 2019 pace. And 2021 is no different. It's been like gangbusters. And you're also seeing a lot of large established firms kind of reinventing their own strategies. You've heard of large firms saying that they were going to raise a seed fund to move into the seed stage because they're getting pressure on the growth equity side from the likes of Tiger Global. So there is an abundance of capital available. In the later stages, we're seeing a significant increase in valuations. It's not that companies are performing that much better. Multiples have gone through the roof. And that you're seeing that even in the stock market. It's not that a lot of companies, public companies, are doing better from an earnings point of view, but their market caps have been the beneficiaries of a significant jump in PE ratios, price to earnings ratios. And so that's what we're seeing in venture. I'd say that for a firm like ours that's in that, what I like to call mango seed stage, we are relatively unaffected because the entrepreneurs are looking for people that can help them find product market fit, discover product market fit in that 0 to 1 phase. It's not just about capital. It's not just about passive capital. It's about active patient capital that people care about. And so that's what we're seeing, at least in the zone that we invest in. However, across the board, there has definitely been an overabundance of capital, valuations increasing, and terms increasing, which again, a lot of people thought wouldn't be the case, that we would have an evaporation of capital and that entrepreneurs would be at the receiving end. That's not been the case.
So speaking of that, we're seeing more and more founder-friendly terms for there's some in the audience who are curious about what does this mean in practice and what are some ways to leverage this. And maybe we could tie in that with the general fundraising advice that you're giving your portfolio companies right now.
Yeah, the general fundraising advice I give a lot of my companies, or for that matter, even when I'm looking at a new company, I try to understand what are the value creation metrics that company needs to achieve. So if I'm on the cap table, it's the same advice I would give our portfolio companies as I would give any company that's coming to us to raise capital, which is it's less so about, what kind of check size we want to write and things like that. Let's first figure out how much capital you need to get to those value creation milestones, because truth be told, if I'm an investor, I don't win till I help you raise that next round of capital. Okay, so so typically what I find is for companies to find that product market fit in that B2B space, because that's where we usually play, it's more like 24 to 30 months of runway. You may end up raising money sooner, and more power to you if you end up doing that, but give yourself that amount of time so that, I would say you want to be in a position where you raise your next round, your Series A or whatever, probably about 6 months before you run out of money. And you want to raise money when you want to raise money and not when you need to raise money. that's kind of what I've generally advised people. And another piece of advice I'd give is this, that is, you want to make sure that you're investing prudently, right? I like to use the following analogy. In that 0 to 1 phase, when you're trying to discover product market fit, it is akin to, I call it, proof of value and proof of market. Finding product market fit sits on these two legs: proof of value and proof of market. Proof of value is you're trying to identify use cases whose value proposition creates this inexorable demand for your product, right? And proof of market is now you're ready to, replicate, come up with a replicable sales model, and then scale the business. But during the proof of value phase, it's very similar to Indian cooking. It's low flame, low simmer cooking, right? And that's why you want to give yourself enough time during that initial phase. I mean, I'll tell you, we have a portfolio company called Climate AI, actually founded by an IIT alumnus, Himanshu. They'd raised about $3-something million in the seed round that we had led. They survived on that for 3 years till they found product market fit. Once they found product market fit, they were able to raise a Series A at a very nice uptick in valuation. So I'd say that is what I mean by that low simmer cooking. Now, proof of market requires a different approach. That requires high flame cooking, right? Because once you found the replicability of your sales model, then it's Chinese cooking, baby. Right? So that would be the other advice I give. Then the last piece of advice, I've got lots more, but in the interest of time, last piece of advice I'd give is hiring talent is a huge challenge in this climate, right? What has happened is, especially with people being able to work from home, finding that work-life balance, large companies throwing a lot of money at them, it's become a huge challenge for startups to compete. So this is where I feel like a lot of founders need to take this very seriously. Be generous at that early phase. And what I mean by that is, be generous in terms of equity, be generous in terms of title. You can't be overly generous in terms of cash, and everybody understands that. But you don't lose anything by calling people your co-founders or a founding member. You don't, cut the pie will grow larger if you're able to give them a sizable portion of the company. I find that some founders tend to be penny wise, pound foolish in that early phase, and they pay the price because even if they're able to attract talent, once they get to some kind of value creation milestone, the early employee is like, okay, I don't have as much skin in the game. I'm going to go off and look at my next company. So you want to inculcate that loyalty to your company and your brand. And, there are cheap forms of recognition that you want to embark on. And leadership matters a great deal. I've written a couple of articles on leadership that are on our blog. So please visit those and read those.
That's a great analogy, Kittu, about going from low flame to high flame. And I've known that you've said before, you want to go from resource constraint to opportunity constraint as well. What are some operational challenges that you're seeing with your startups? I know we talked about hiring issues, supply chain being choked, and finding local manufacturers. Collaboration is another that you've touched upon briefly.
Yes, collaboration is a pretty significant issue in the sense that, when the work culture changes from working in the office to working from home, it's likely that productivity improves, but collaboration takes a hit because, now you are, gone are the days when you can just stand up, look over the the aisle and reach out to somebody and ask, or walk over to someone's office, ask a question. No longer it is as real time as that. And so that's something that we've paid the price. And I think there's an opportunity to improve those collaboration tools significantly. I talked about conserving cash earlier, so I'm not going to repeat that. There is actually a lot of liquidity in the market. There is a lot of capital available. However, you want to make sure that you achieve some of those value milestones, and you're able to tell that exciting story. I also say, give this advice to a lot of young startups is, one shouldn't always think about this, and this is probably good advice even for venture capitalists, is, we have this somewhat, I'd say, negative culture on the West Coast in particular, where everyone feels like they need to go long all the time. And it's unicorn or bust. No, that's not true. Sometimes the best outcome for you is to sell the company at the right time. And every round of financing is an opportunity for founders and existing shareholders to look at themselves in the eyes and say, hey, should we go long or should we go short? Is this product or technology better in the hands of someone else, or have we earned the right to be an independent company? So that's something that they should think about. Another key piece of advice I give a lot of companies and young companies is this: startups cannot survive without some wind in their sails. Right? Because you are trying to disrupt the status quo. You're trying to compete with some of the large incumbents. You need some tectonic shift that you're taking advantage of. So this is a question I almost always ask entrepreneurs that meet with me. Why now? Why do you think what you're building needs to exist now? What is that? What has changed out there? What is that tectonic shift? Where is the puck going to that you want to? This is where it requires a certain amount of nonlinear thinking, of looking around the corner, reimagining the world and saying, hey, this is what the world is going to look like, and we're going to take advantage of it. And if you can then convince the venture capitalists to look at the world through your eyes and maybe help you shape that vision, then you've got a partner, right? That's what I would advise. And this is where, you start off with pitching to your friendly investors first, right? That's what we do typically to our portfolio companies. We put them in front of firms that are friendly with us and that will tell us what we need to hear. More importantly, tell our entrepreneurs what they need to hear so that they can benefit from that advice, figure out what objections they might run into, weed out those objections, right? So there's also other forms of capital available. It's not just venture capital alone. There is corporate VCs, there's strategic funds that all are waiting to invest in companies that might be synergistic with what they're doing. So these are some of the pieces of advice I'd give young startups from a fundraising point of view.
Kittu, there's a lot to pick your brains on this topic, but in the interest of time, I'm going to very quickly ask you about what opportunities you expect ahead of us. And specifically, I know you're super bullish on the intersection of bits and atoms, despite all the challenges that we're seeing right now. So would love to hear your thoughts on that.
Yeah, you've heard me say this, Kirtika. There is a lot of innovation that has happened in the world of information technology, as I call it, the world of bits. And that innovation is going to continue. There's no question about that. All right. If you look at what's happening in the world of AI and machine learning and computer vision, natural language processing, it's amazing, the advancements there. and not to mention some of the associated even hardware innovation, the chip technology innovation to make AI faster, to make training models faster and things like that. However, I believe that we are at the cusp of something phenomenal at the intersection of bits and atoms, as I like to describe it, at the intersection of multiple disciplines. What's happening is that there's, like, if I take an area like human biology or life sciences, there is suddenly an abundance of data available. The UK Biobank, for instance, has genotype, phenotype information for 500,000 people. And from that proprietary data or public data, you can apply pretty much off-the-shelf algorithms to identify certain, interesting targets for drug discovery, identify certain compounds that could be ideal for certain diseases that have yet to be treated properly. So that's just one area. Clean energy is another area where I think there's a huge opportunity to leverage data science, computer science, AI, ML, computer vision, and most importantly, data, the availability of data. Not to mention, industrial IoT, manufacturing, and things like that. So 3D printing, robotics, these are areas that I think are phenomenal areas of innovation. And that's something that we have actually embarked on as an investment thesis, rather made it more strategic rather than opportunistic. So that's what I kind of mean by bits and atoms. And I hope, 2 years from now, when we have another similar conversation like this, you'll say, I thought you were throwing platitudes, but you were so right.
And on that realistically optimistic note, I'll pass this on to Nidhi. But thanks, Kittu. And I'd encourage anyone more curious about this to take a look at Kittu's portfolio. He definitely walks the talk. So take a look.
Thank you, Kirtika. And thank you, IIT Bay Area.
Thank you so much. Thank you, Kittu. Thank you, Kirtika. And thank you, Yash, for joining us at the start of this talk to introduce the speakers. Really grateful.